tune out this amazing song, you know I hate to. All right, so we are live. Thank you guys for joining me for tonight's special live stream. Normally I do videos with Charlotte, that's just stories, but tonight I combine something that we do for all of our clients, all of our Sphere. This is a quarterly event that we host that's just about building generational wealth by doing things like budgeting or learning how to tweak our credit, fun things like that that we can do to really just put ourselves in the best place when it comes to building wealth for but not just us, but for the generations to come. So without further ado, let's jump right in. I know that a couple of you are on here to get some credit knowledge and learn from some of our credit tips. So a little bit about me. I have been in the mortgage industry for over 20 some odd years, and I have seen credit change and what requires, just in the last 6 months, we've had major changes to what is impacting a credit score. So let's go over a couple of things. We're going to talk tonight about basics of credit, things that maybe not everybody knows because they haven't been doing mortgages for 20 years, just some real basic information. This is going to be great for anybody that's stepping into the credit arena, learning how to build their credit. We're also going to talk about some repair. So if you've ever had some blemishes on your credit, we're going to talk about where you can focus to really get the best bang for your buck, typically when it comes to credit repair. And then also we're going to teach just quickly how to maintain a credit score, or maybe just get a couple of points to really increase and get you the very best possible interest rate, from cars to credit cards to really auto insurance. Everything requires good credit these days. So without further ado, let's jump right in. If my screen wants to let me, there we go. So what is credit and why do we need it? I get this question a lot, especially from people that love to live by cash, right? We have a lot of people that just want to pay cash for everything. It's a great policy. However, it does not build credit. And they're like, why pay cash for everything? That should give me a good credit score. Well, the problem is credit is literally proof of financial responsibility. So the way that we build credit is by proving that we can be financially responsible for money that has given to us for us to pay back, like car loans, credit cards, lines of credit, things like that. So the definition of responsibility is the state of being responsible, right? So we can't prove that we're responsible without showing pay history. Now, with that being said, I'm going to go ahead and answer the questions. Can you get credit with, or can you buy a home, or can you buy a car with no credit? Absolutely, because you know what, there are things that we can do to prove that you're financially responsible that are outside of the traditional credit bureaus. So just so you know, we can do things like look at rent history. That doesn't typically show up on your credit score, right? Or look at what you're paying your utility bills, or even putting money in savings every month. If that's something you do all the time, that's considered a proof of financial responsibility. So don't get too hung up. There are ways of living this life without ever building and establishing official credit through the credit bureaus. But having official credit does make it a little bit easier, and oftentimes gives you better interest rates. So remember that responsibility, we're proving our responsibility. What is responsibility? Well, we have the ability to choose how we respond in any given situation. That can be in life. If somebody punches me, I have the ability to respond with a smile, or I can punch them back. Choose whatever, I might punch them back. Depends on the day. But in financial responsibility, it is how we respond when we are given offers for credit cards, when we are financing versus saving, when we are spending, what we respond to and how we respond financially to things like income loss, job loss, things that happen in our life. Your financial responsibility comes from, and your credit score comes from, how you were responsible and how you responded to things like that in your life. That is literally what the credit bureau is scoring. So let's talk about the basics. Let's talk about the good, the bad, and the ugly. We're going to start with the good. What makes good credit? Official good credit on the 3 credit bureaus are going to be driven from having things like installment debts and revolving debts. So those are the 2 types of debts that can show up positively on your credit bureau. Installment debts are things like mortgages, a car loan, educational loans that are paid that are a fixed amount that can't go up. So the way that I look at this is, an installment loan is something that I borrow a fixed amount right up front. And when I pay it down, the balance goes down and I can't increase the balance by spending more on it, like a revolving account. So another good way of building credit is through revolving accounts. This is things like credit cards, lines of credit. A home equity line of credit is a revolving account. And sometimes overdraft protection accounts. So when your bank offers you a line of credit to cover you if you went too low in your account, and maybe you forgot that you charged an extra tip on something and oof, your account went negative. So they used a line of credit that you then borrowed to pay that up, and then you pay that back and it goes up and down. So that's the difference in the two good ways of building credit, the good things on your credit. So the reason I separated the bad and the ugly, let me explain this a little bit. The bad are things that are going to affect your credit score negatively, but you can get around it by fixing it often, right? So you could fix your credit and then still buy things and get your credit score up and still buy a home. The ugly are things that affect your credit negatively, but they can also affect your ability to buy a home or sometimes a car or finance that has nothing to do with your credit score. So remember, the bad are things that are going to affect your credit score. The ugly are things that no matter what you have as far as a credit score, if you have an 800 credit score, if you have one of these ugly things on your credit, it can actually still inhibit you from utilizing your good credit score. So the bad is things like collections. Everybody knows if you're late on your credit that it can actually hurt you. So quick question in the chat, or if somebody wants to speak up, does anyone want to take a guess as to how late do you need to be on a credit line or a credit card or any of your debts that are on your credit? How late is it going to be before they report negatively on your credit? Anybody want to shout that answer out? Take a guess, take a guess.
30 days.
30 days, that's right. 30 days is the correct answer. So that does not mean that you're not going to have a late payment if you don't pay it by the time that they say you're going to be late, right? So on my mortgage, it says, if I pay my mortgage by the 15th of the month, I'm not going to have a late fee assessed. But even if I pay it on the 20th, because it was due on the 1st, I'm still not 30 days late. So it's not going to negatively affect my credits. I do give you a really nice window to get that paid before it negatively affects you. And then it's every 30 days that it hits more negatively. So a 30-day late is going to be a ding to your credit. A 60-day late is going to be a bigger ding to your credit. 90 days, 120, and then it goes into collection, right? So late payments on your credit are the bad. Charge-offs. This is where maybe you had a credit card when you were 18 and you didn't know financial responsibility, and you got this really expensive credit card that had horrible yearly fees. I see this all the time. Fees on those new credit cards are killer. And it just went to collections. You didn't pay it, and finally they charged it off. So they're not trying to collect from you anymore, but it is showing on your credit poorly. High revolving on debts. So this is something that not a lot of people know. I think it is becoming a little bit more known out there. But if you have a credit card or a line of credit, a revolving account, and it has a $2,000 limit on it, and you borrow $2,000, your credit score is going to drop almost the same as if you had a 60-day late. Let that sink in for a second. If they give you a credit card with a limit and you spend close to the top of that limit, it's going to hurt you just like you had a late payment on your credit. And if you go over that limit, it is like having a 60-day late. So just so you know, credit utilization is huge, very important, especially when you're building credit in order to keep that credit score increased. And it's also a wonderful hack. If you have a 680 credit score and you're trying to get up to that next level of like a 700 to get a better interest rate on maybe a mortgage or even a credit card, a great hack is paying the revolving balances down below 10%, because that helps your credit. Nice little hack on there. And not have any active accounts. I have lots of clients that will come to me. I actually had one last week. They came to me and they had credit accounts. They had a car loan that they paid off 3 years ago, but it hadn't been active in the last 12 months. And they even had a credit card that was open, but they had not used it. They had not paid or used the credit on that credit line at all in the last year and a half. I think it was actually 2 years. So their credit score was really low. Sometimes it'll even go away. You'll go back to having no credit, even though you've got credit history, but because it's not current, it will not give you a credit score. So those are the bad things that can pop up on your credit. But let's go to the ugly, because remember, the ugly, it doesn't matter what your credit score is, they can hinder you from getting a mortgage or other loans and credit cards. Really, any line of credit. It can also affect your insurance rates. So the ugly are things like bankruptcy, Chapter 13 or a Chapter 7, they ding your credit the same. Judgments, that's where you didn't pay something, it went into collections, and then they actually filed a lien against you in courts, and it's attached to you. Foreclosures. Mortgage rates and foreclosures are huge when it comes to buying a house specifically, but they also, mortgages are an installment account. They have a heavy weight when it comes to having rates on your credit. And lastly, the beloved student loan. So student loans, even though they only stay on your credit for the normal time that things stay on your credit, the federal student loans, even when they fall off of your credit, can still haunt you. Whenever you try to go for any government financing, which a lot of times is a mortgage, that is an FHA, USDA, VA. If you're trying to go and get a small business loan through the government, the SBAs, those are government loans. And the government has this ugly thing called pavers, which is the naughty list of people that have debts that they have not paid back to the federal government. And student loan debt, even though it's not showing on your credit score is not affected by it anymore. That student loan debt, that it's a federal debt, if you still haven't paid it, then you have to pay it before you get more federal funds. Uncle Sam wants their money before they give you some more. Any questions over that? Perfect, let's keep going. So everybody asks me, what is the difference in Credit Karma and the mortgage credit pull that I just got? And sometimes credit cards, like, does anybody have a Capital One card and it tells you what your credit score is for Capital One? Well, they're using something called a Vantage score. Vantage scores are super cheap. It's also like a soft pull. It gives you an overview, but they're scoring it very differently than a FICO. It doesn't go as deep as your other type of credit score, which is your FICO score, which is what you use for mortgages and bigger loans. And the way that they look at different things is different. So Credit Karma might say you have a 700 credit score, but that's because Credit Karma is only using your credit utilization at 18% of their score. So when you've got high credit utilization, it's only hitting you about 18% of it. Whereas on a mortgage or a FICO, which is a more expensive, much more detailed credit bureau, it looks at utilization at 30%. So things like that, because the pie shifts a little bit, it's still a great indicator of credit health. They're amazing. We love the Credit Karmas. We love the free credit scores that we get from our credit cards and things like that, or going to Experian.com. But those scores that they're giving you are the Vantage score. And just know that when you go to get your mortgage, it could be different. And sometimes it's higher and sometimes it's lower. Some are like, well, is it 20 points lower? Well, it depends. Which one of these pies is going to have the biggest difference in your credit? And that's going to tell you which one is going to be higher or lower. So the Vantage score is amazing for seeing ups and downs. It's great for finding somebody stealing your credit. That's what it's amazing for, because it tells you if somebody's opened a new account. That Vantage score and Credit Karma, or your credit watchdog that's on your Capital One account or Chase account, any of those credit cards, they're fantastic for monitoring, but they're not your actual FICO score. So FICO score is different than credit score, just FYI. So let's talk about some do's and some don'ts as we're building credit, okay? So if we're starting to build credit, if my teenagers out there are looking to make smart decisions when they go into college, and when they go to those job fairs or college fairs and they're offering free credit cards left and right, and you think, I want to do this because I want to buy a house, or I want to build my credit because I want to get a better credit score down the road. Couple of do's and don'ts. Real quick, I'm going to stop. I'm going to tell a quick story because this is my story time anyway. I have to tell you about my first credit line. I wanted to build my credit, and I didn't have an amazing company like Atlantic Bay out there to tell me how to build my credit. Had no idea, right? So I go out and I decided that I wanted to buy a Yorkshire Terrier. If anybody knows me, you know I absolutely love the dogs. And I wanted a Yorkshire Terrier. It was my very first dog. My mother is on this call. I can see her. She probably remembers Tyson, the cute little dog that jumped really, really high. He was an amazing dog. No, he was actually really a horrible dog, but that's okay. We loved him. I wanted to build credit, and this dog was $500. So I went out and I bought a credit card. I got a credit card just to build my credit, one, and two, to pay for this dog. Well, my credit limit on this credit card was $500. Not only did I go and pull out $500 from my brand new credit card, that credit card had a fee of, I think I was 18, so I don't remember exactly, but maybe $100, right? Whatever the fee was. So I pulled out $500. They charged me $100 because I opened the account. That was just their credit fee. The interest rate, I think back in the day, it was like 23%. I don't know. It was dumb. It was super dumb. And I just had utilized over my credit limit. So for me to build my credit, I went out and used it to buy a dog to build my credit and killed my credit. That's what I did. I went out, and before I had anything on my credit, I just threw it in the trash. So lesson to be learned here: do not get a credit card and spend to the limit when you get it. That is not the way of building credit. So do maximize positive credit by keeping balances at a 6% ratio. So what does that mean? If I get a $1,000 credit card, that means I don't spend more than $60 on said credit card. You heard me, 60. That's how you get the very best credit score. Now, as long as you keep it under 10, it's not going to hurt. If you keep it under 10%, so if you spend 100, it's not going to hurt you at all. But keeping it at 6% is going to be that's the sweet spot for credit. And real quick, I'm going to go to my chat. What's the difference between a hard pull and a soft pull? Very good question. The difference between a hard pull and a soft pull, I'm actually going to go back real quick. The difference between a hard pull and a soft pull is a soft pull is using a Vantage score typically. So the Vantage score is normally what you're going to get with a soft pull. However, with that being said, mortgage companies across the nation have recently, and we are one of these companies, not just us, but others as well, have partnered with our credit partners, and they are building their own Vantage score that pulls the same percentages. So they're modeling the FICO. So if your mortgage company does a soft pull, it should be really close to your true FICO, because our credit bureaus, we're spending big money with them. Ridiculous. You don't even want to imagine what the credit score bill is for a mortgage company. It's nuts. But because we spend this great big money with our credit scoring companies, they have put together their own Vantage score that mirrors FICO. So it's not what credit companies use, it's not what credit cards use, it's what mortgage companies use. But your Credit Karmas, your credit bureaus, a lot of times even credit cards will use the Vantage score for decisioning, not just a soft pull. They'll do a hard pull through Vantage. But most soft pulls outside of the mortgage soft pulls are going to be using that Vantage scoring system because it's cheap. It literally costs, a company can get a Vantage score for less than $1. To keep that in line, a typical cost for a FICO, a mortgage pull on your credit, for a hard pull is going to be somewhere around $35 to $65. And a soft pull with the credit is still going to cost us about $20. So much, much more expensive than the Vantage score. Great question. Thank you. So let's go back to the do's. Make at least a monthly payment every month on a credit card. So what does that mean exactly? I mean, of course you're going to make a monthly payment, but remember, if we have a $1,000 credit line because we're brand new, they didn't give us a big credit line, and I'm only using 6%, that's $60. So I could literally go put a half tank of gas in my car, right? I could put a half tank of gas in my car, and then I'm going to pay that off at the end of the month. But that's not making a monthly payment every month if I do that just once. So what that means is spend a little, pay a little, spend a little, pay a little, spend a little, pay a little. That is what that means. So keep accounts in good standing. This is my duh moment, but don't be 30 days late on anything. Like financial responsibility. If we're building credit, don't be late. That's kind of a given, right? So don't use more than 10% of the available limit on your card. 30%, if you're over 30% utilization, it will start dinging your credit. Not big, little dings, but it will start dinging your credit. It's gonna, instead of increasing your credit, it's going to start decreasing your credit score. Open and apply for a bunch of accounts. So everybody's heard credit inquiries hurt credit. Yes, absolutely, they hurt credit. Now, with that being said, side note, there is this falsity. There's this thing that people think they can't shop for something because if I have a credit inquiry, it's going to hurt me if I keep doing credit inquiries. If you're shopping for the same thing, it doesn't hurt your credit. For example, if I have 8 credit pulls for a car loan in 120 days, if that's the only credit pull I had was 8 of them for a car loan, that didn't ding my credit. But if at 90 days after I shop for a credit in January, and then in March, I decide to buy a house, now every single credit pull is going to hurt my credit because that's a different thing that I'm shopping for. You got to get outside of that 120-day window. So if you're within 120 days and you're just shopping for one thing only, the credit bureaus recognize that and they see that you're shopping for a car or they see that you're shopping for a house, and it doesn't hurt your credit unless you have shopped for something else in that rolling 120-day window. So that's tricky because, like, when did I apply for that Kohl's card? When did I apply for that card? It may have been in that 120-day window and it does hurt you. So the best rule of thumb is don't pull your credit unless you absolutely need to. Don't get sucked into getting every single store card. They're a sham. They're a sham. Don't get them. I have one. I'm completely guilty. I've got a Kohl's card. I haven't used it in years, but I totally got it because it saved me money. Not a good idea. It was a credit pull. And actually, another story, Charlotte, who had been in the mortgage industry for 20 years, literally did the no-no. I was refinancing my house when all those rates went crazy in 2020. And I opened a new credit card because of a discount. Yep, I did it. Charlotte, who tells her clients not to do that, did not even think about it and did it. To my defense, I was doing a refinance through Atlantic Bay and it was so easy, I forgot I was doing a refinance. True story. I'm not even trying to give a plug, but it really is true. All right, so don't do that. And don't run late on payments and don't close accounts. Now, there are some times that you can close accounts. I, for one, have way too many accounts that I don't use that are just sitting open. If you've got a nice mix on your credit, you can close the extras. But don't go closing a revolving account just because you don't use it again if you don't have a lot of revolving accounts. That account, especially an old revolving account, because that old revolving account is probably really helping your credit score. So that's kind of one of those things that people are like, what? Why would you not want me to close it? I don't have the credit anymore. Why do I need that credit card? It could actually be helping your credit. Here's a hack, and my children, I'm not sure if any of them are watching right now, but they definitely got this lovely hack. I can build someone's credit by adding them as an authorized user on a credit card. If this is very, very important, that utilization needs to be at 6% or less. There can never have been a late on that credit, at least not in the 7 years where it's going to report. Don't hurt your kid's credit. That's not a good idea. Make sure it's never had a late. You're doing low utilization, and make sure it's one of the major credit cards, because some credit cards, I can't even remember. I think it was Truist. There's a bank that does not report the authorized user account on their credit. But most of your big ones, your big name credit cards, your Chase, your Bank of America, your Capital One, Discover, all of those credit cards, when you add a child as an authorized user on that account, they get the entire history of that credit card on their credit. Now, that's not going to be enough for them to go buy a house tomorrow, but does that jumpstart their credit score? I can tell you right now that my daughter has a better credit score than me, because the only thing on her credit is a credit card that I got before she was born. Yep, before she was born, and her house. So because of that, her credit score is like in almost 800. She's very close to an 800 credit score. What people try to get, which, by the way, do you guys know how long you have to have open credit on your credit bureau to have an 800 credit score, typically? Take a guess. It's longer than you would think. 24 years. So if you didn't hack, you're not going to have an 800 credit score until you're, old, or not old because I'm old enough to have that, but older, all right? But this is a hack. Very important that you don't have a high utilization, you don't have late payments. And by the way, I did not give my kids the credit card. Like, they couldn't use it. I didn't give them that card. I'm not that dumb. I just added them on the account and then put the card in my little thing. And one time it did come in handy because my son wanted to rent a car and he did have a credit card in his name because I had the authorized user. So that's just a quick hack that you can do, especially parents, if you're out there trying to build credit for kids. So let's talk about collections, because a lot of time people are like, I'm going to work on my credit. I was young, I was dumb, I'm going to pay off all of my collections. It doesn't help your credit a lot of the time. It doesn't help your credit because when you go and you pay off a collection that's 5 years old from when you were young and dumb, the date of last activity on that collection account is probably 5 years ago. And that balance is old and it's not really affecting that credit score that much. If you go back and look at that graph, you're going to see it doesn't affect it that much. But if you go and you pay it off, it changes the date of last activity to more recent. And now, even though it's a zero balance, it's going to show a recent collection activity. So that's not always the case. There are some times that paying off a collection, especially if it's very recent, a very new collection, and so that date of last activity isn't going to hurt you. So catching it early is good. And if it was a credit card and it went into collections with a high balance, so your utilization is super high, you're getting dinged not just for the collection, but you're also getting dinged for a high utilization on all of your accounts. Just something to think about. So not always is paying off a collection the best idea. With that being said, if you're looking to buy a house and you're wanting to get your credit in the best possible place before you do so, and you might have some old stuff on your credit and you want to know what to do, your mortgage professionals, like all of us at Atlantic Bay and many others, would be glad to pull the credit, ask before they do it, ask if they have simulators to see, like credit simulators. We have these. Again, we pay millions of dollars for credit bureaus. We have lots of tools that we can help. We'll be glad to look in there and do the simulator and see if it is worth paying off those collections or charge-offs. Massive update. This happened in the last 6 months. I want to say July of 20. Okay, maybe it's a year. Okay, time is flies. In the last year, this has happened. They changed medical collections, and this is big because, guys, in this mortgage industry, I see more medical collections on people's credit driving scores down than just about anything out there. Because you go to the doctor, you didn't sign up to go to the doctor. You didn't know you were going to get sick. You had to go to the doctor because your arm was coming, you know, your hand was broken, or you got hit by a car. Charlotte's done that before. Don't recommend it. They made a change to where once it is paid, it can go on your credit. If you've got a collection, there's lots of rules. It can't go on for a long time. They've got to have tried to get in and fix your credit. However, if you pay it off, even if it's big, even if it's small, if it is showing as paid, it will be removed from your credit. In a moment, I'm going to get into how to make sure that happens because, as you can imagine, with the billions of medical collections that are on people's credit right now, there are probably some paid collections sitting on people's credit. I've seen them that have a zero balance and they're not updated because, you know, medical collection companies aren't the best, right? They're not the most fun, and they probably aren't the most swift at getting those reported to your credit. So at the end of this show, I'm going to show you a couple things you can do to make sure if you've got some of those, you can get them done. But also, this is the newest update, and I love this because I would see 50 medical collections for $40, $30. The copay at a doctor's office would be a medical collection, and each collection is dinging your credit over and over and over. $500. If the medical collection is lower than $500, it will not go on your credit. That is amazing news. I think that was one of the best things that's come out with credit help recently. It's a great thing to where doctors aren't killing people over $35 on a copay or a small debt that you just didn't know about that's hurting your credit score, sometimes knocking you out of the ability to buy a car or get an interest rate on a house or a credit card. So that's a really good change that came out recently. So why does credit matter? I keep on talking about getting a better interest rate, right? If you guys saw my quick story the other day, I put on there the difference in a $300,000 house if you have a 660 credit score versus a 740 credit score. It was at least $300 a month, if not more, because if you had MI, your MI would actually be higher on that. $300 a month difference. That's another car, right? That's huge. So let's look at a couple of others. These are just some good estimates. This is right from NerdWallet. Thank you, NerdWallet. We have got, if we were doing an auto insurance policy, if you've got great credit, a 720, 760 or above, policy average, national average is $1,500. If you're a 680, which is still a good credit score, it goes up over $200. If you're subprime, Look at that difference. We're looking at over $400 or $355 difference. And then deep subprime, that's rough. That's about $3,000 on auto insurance. That's a big difference. Is that alone worth working on your credit and getting your credit score up? Absolutely. Personal loan, not many of those out there right now. Every once in a while we see personal loans, but big difference. Most of those have much higher interest rates if you have bad credit. And sadly, the people that get personal loans for the most part are typically people that have a credit blemish or they're in credit trouble. They need they're trying to do some debt consolidation because they're in over their head. And those rates, I very rarely see one under 14%. So that gets expensive. And credit cards. This says that 2%, the normal credit card is 12% if you've got good credit. If I've got a 760 credit score, I'll be darned if I'm paying any interest on my credit card. I want zero interest all the way. But they're being conservative. They're saying 12% versus 21%. Look at that difference in how much you paid in interest over that year. $2,200 in interest versus $6,900 in interest. That's impactful. So just a couple of things to really bring in why it's important. One, for us to work on our credit, and for the love, teach our children. They don't teach this in school. It's crazy. They need to teach this. We need more education around this so that we put people in a better starting point. This is huge. Make sure and share this. This is going to be recorded. It is recorded. You can go to my Facebook and see it. If you've got somebody in your life that's spreading their wings and starting this lovely adulthood life, please show them this video so they can learn this. And remember, this goes not just for insurance, not just for auto loans, your salary, getting a job now. I know that I had to have my credit pulled when I got a job. Lots of financial jobs require a credit pull. So just getting a job can really be affected by that credit. All right, so every point helps. So I'm going to give a couple of scenarios where credit points, where credit is and what it looks like. So I mentioned that 800 credit scores, you've got to have credit for a long time. But really, a 760 is considered nearly perfect credit. It's where there's not much above that that's going to get you a better interest rate. If you've got a 760, you're in the top bracket. It used to be 740, but they've moved the needle. We're at 760. That goes for mortgages, that goes for cars, that goes for credit cards, across the board. If you're a 760 FICO score, you're sitting in the perfect credit range. Typically, the next buckets go down in increments of 20, and this goes for car, credit card, and home as well. The typical is 20-point variances. So 740, 720, 700, 680, 660, 640. So in our mortgage world, I will share that a 640 is a huge bar when it comes to mortgages. 640 and 720, those two brackets are monumental when it comes to what loan program you can qualify for, what your interest rates are, things like that. And then when you get below 640, in the mortgage world, we can go to 620, we can go to 600. Some companies go below 600. We stop at that 600 range, which is still pretty aggressive. But again, you saw what the difference was in the monthly payment at a 660 versus a 740. So you can imagine how much money extra you're spending if you start at that 600 score. So let's start and get it back on track. So now, real quick, what's our time looking like? All right, perfect. I've got just a few more minutes, and then I'll answer any questions that anybody has. Correcting mistakes. We see lots of mistakes on the credit bureau. Everything from identity fraud. We don't see that as often as you would think, but I think that's because people are starting to catch it earlier, but it still happens. The credit report just having something incorrect because they haven't updated. That's probably not the credit bureau's fault. It's probably the company that reported it originally. Medical collection companies, they're notorious for that, or any collection company is notorious for not reporting and updating quickly. But just this week, one of my mortgage loan officers, they had somebody that has a car payment that they paid off the car 3 months ago, and it's still reporting them as 30 days late. They don't even have the loan anymore. They don't have the car anymore, but the credit bureau just isn't updating because that company has not updated their credit. So correcting those mistakes is huge. First, knowing what's on your credit is step one. So if you haven't applied for credit recently, you can always go online, and I'm going to put this in our chat. Actually, I'm going to put this in the event details. I'll put the link to the place that is federally monitored, and it is a free place to get a copy of all 3 of your credit bureaus. Annual credit report will absolutely, once a year, you can get Everything. It is literally all of the information from your credit bureau. You can get it from all 3 credit bureaus once a year. You can do that all at one time if you want to get all of them at one time, or you can split it up. Do one in June, do one in August, do one in January, however you want to do. There's 3 credit reports. You can get one from each every year for 100% free. Be careful, use the link that I post, because there's lots of things that if you spell it off one word, it takes you to another site and they hack in and they charge you for such things. So be careful. Use the correct website to get that free copy of your credit. And then to correct things that are on there. If you're on your phone and you want this information, snap a picture of it. These are the phone numbers, the addresses that you can go to and contest something that is on your credit. So if you've got a dispute that you need to make, you paid off medical collection, it's still there. You see a medical collection that's under $500 that's still reporting on your credit, you want to get it off. So you give the details of the credit. You've got your credit bureau that you just got for free from annual credit report. So you've got that. You're going to give the account number. You're going to say the date that it opened, the day that it's there, the balance that it's showing. Hey, this is a medical collection. It's under 500. It should not be on my credit. You can write the letter. You can also call them. It takes you a while to do the call, and all 3 of them do have websites. You can go to Experian.com, TransUnion.com. All of the actual credit bureaus now have a way that you can do that online as well. So take a snapshot of this. This is how you dispute the credit. How long does it take? Great question. It should, if you provide the correct information, you give lots of details and paperwork, you prove without a shadow of a doubt that that credit was paid off. And or you get a letter from the creditor. This is a beautiful thing, getting a deletion letter or getting a paid letter from the actual creditor that they mail to you and sending that to the credit bureau. It'll be resolved within 30 days. So that does it very fast. But if you don't have enough documentation, then it's a back and forth. And I've seen it take months because it goes back and forth. They have to answer within 30 days, but they can answer with, well, this isn't enough information. We need this. And then they wait on you to provide more information and get the documentation. So with all that being said, it is very important to get as much detail as possible. And truly, if you can get the letter from the creditor. So you've called the creditor, hey, you're saying that you're still reporting this on my credit. It shouldn't be on there. I paid it off. Or it's below $500. It's a medical collection. If they say, oh yeah, you're right, we'll get that fixed for you. No, I don't trust you. You're a collection company. You're not going to get it fixed fast. I would like you to drop in the mail today something that says that this is paid and shouldn't be on the credit report, and we're going to remove it. It's called a credit deletion letter. Now, if it's not a medical collection, you're probably not going to get a deletion letter. You're just going to get an update like, yes, this was paid. It doesn't need to be there anymore, or doesn't need to be showing a balance anymore. Or you called somebody, they were reporting you 30 days late, you know for a fact you weren't, you called them up, hey, I wasn't 30 days, look at this. They do research, they come back, they're like, yeah, you're not 30 days late. They send you a letter that says this account was never 30 days late, has your account information. You send that to the credit bureau, you're going to see results. Absolutely, you're going to see results. And just a little side note, if you're in the process of buying a house, buying a mortgage, getting that letter, we can do something called a rapid rescore. So if we know that we've got your credit pulled, we've got your file, we're just needing a couple tweaks before we can get you into underwriting to buy a house, we can get this done in, depending on the credit bureau, 3 to 10 days. So we can do this very quickly, but we need that letter from the creditor. Remember that we need the letter from the creditor. All right. All right, everybody. So we are right now at 7:07. We're finishing up a little early, but I did want to take any questions. If anybody has any questions, I'm going to open up the chat and you guys just let me know what I can help with. Any chats, any questions at all? Hey, Shanika, you're still here. I thought you were going to go make a charcuterie board, girl.
I did. But my question is, what's the easiest way if you have a lot of revolving debt, so credit cards or home equity lines, what's the easiest way to tackle some of that debt? Do you have any tips?
Very good question. Yes. So there's a couple of different theories to this. And I'm going to say if you're tackling it at all, you're doing the right thing. All right. So if you, whatever theory you want to take with this works. There is the Dave Ramsey way, which we actually talked about that in our budgeting class. First and foremost, you got to get a budget, right? Get a budget, number one. You can do the snowball method. And this is a great method because there's something psychological about doing the snowball method, which is great. That's where you start with the smallest credit card and you pay it off. And then you go to the next credit card and then you pay it off with the balance, with the payment that you had on that one, you pay it on the next one, right? And you snowball because as you pay off debt, you have more every month to apply to the next debt to get it paid off. So that's called the snowball method. It's a great method. And there's just a psychological reward and feeling of accomplishment when you get that small one and you get it done. You've got something done. You feel like you've accomplished something and you move on to the next. So it gives you like momentum to get to the next one. So that's a great way of doing it. Another way is by looking at the one that has the highest interest rate. So if you don't need the momentum, you just know you're disciplined. I know I'm going to pay X amount every month. I'm going to get a bonus and I'm going to pay this off. Then look at the one that has the highest interest rate and start paying that one off. Because again, the more interest rate, the more you're bleeding, right? We're going to cut off the bleeding. And that's another way. But if it's a larger account, that can sometimes take longer and we don't want to get discouraged. So you've got to know yourself. You've got to know what makes more sense for you. Can you be diligent? Can you set your budget and know that every month you're going to put an extra $300 no matter what? You're going to be excited and you're going to pay off whatever that's out there? Or do you need the psychological, I'm making traction, I'm getting things gone and off of my credit? There's a third way I'm going to mention, and this is not for actually getting rid of revolving, but this is if you're getting prepared to buy something like a car or a house and you're doing it for credit score. If you're doing it for credit score, then start with the cards that have the highest utilization. So forget the lowest, forget the one with the highest interest rate. Which one do you owe close to the limit? Which one do you have very little extra in? And start there. Because if we're trying to increase credit score, if that's our goal, then we've got to get those utilization numbers down. So that might mean that I spread it out a little bit. My Discover card has got $800 and it's only got a $1,000 balance. I'm going to get that paid down to $300 as quickly as I can. My Capital One has $4,000 and I owe $3,000. I'm going to try to get that down to $2,000 as quickly as I can. You see the point. So really depending on what your end goal is, if we're just trying to get rid of debt so that we can afford more and get ourselves in a really good financial place, Dave Ramsey is a great way of going. If you're super strict and you know exactly how much you're going to apply every month and you just want to hammer out the one with the highest interest rate, great. If you're doing it to increase your credit score, go with utilization. Did I answer your question? Awesome. All right. Anybody else? She's making the charcuterie board. Get it, girl. All right, everybody. Anybody else have any questions over that? If not, I will jump off. Hey, everybody in my live, if you guys put questions in the actual live video, I couldn't see them here because this was a Zoom. I will answer you when I get back to my Facebook page. Thank you, everybody, for joining me tonight. I hope this was helpful. Share it with somebody if you know that they need it. Let's help our next generation in building their credit. Let's start early, because you know what? It's a lot easier to start good and keep it good than have our blundering 20s and having to fix it down the road, which is what a lot of us had to do because we weren't taught, right? Thank you again. This is Charlotte with Atlantic Bay Mortgage. We are here for any of your mortgage needs. We would love to help you. I've got an amazing team all over Indiana, Kentucky, Tennessee, North Georgia. We go into North Carolina, Texas, you name it. You take that state, just take the country and divide it over. And that's where we are over on that East Coast. We would love to help. Thanks everybody for joining.